So what is inherent risk? When we look at the risk of material misstatement, we're looking at two factors, inherent risk and control risk. I find that a lot of people get confused about inherent risk. So let's break this down. If you'll allow me, I'm going to actually read the definition. I know in videos they tell us not to do this, but bear with me a moment. Inherent risk is described as the susceptibility of an assertion about a class of transactions, account balance, or disclosure to a misstatement that could be material, either individually or when aggregated with other misstatements before consideration of any related controls. Now, think about the term inherent risk. Obviously, there's two different words here. So let's look at the definition of those words. Inherent is defined as existing in someone or something as a permanent or inseparable element, quality, or attribute. So if I had an apple here, I'd hold up the apple and I would say the apple is inherently sweet. It's something permanent about that matter. So when we're looking at assertions, they have certain characteristics. If we look at the synonyms for the word inherent, here's a few of those. Built in, another is characteristic, another is deep-rooted. So when we look at the word inherent, we're looking at what is built into a particular item. Now here we're looking at assertions, and we're trying to see what is built in terms of the inherent risk. Now the second word there obviously is risk. So let's look at that definition. I'm trying to break this down into complete detail. So the word risk is defined as exposure to the chance of injury or loss. So I'm just getting these definitions out of a dictionary. But risk is exposure to the chance of injury or loss. So when we look at inherent risk, we're looking at what is built into a particular assertion and whether or not there is a chance of injury or loss. In our case, there's a chance of misstatement. Now, one of the things you see in SAS 145 is it talks about inherent risk factors, and some of those are susceptibility to fraud, another is subjectivity, another is judgment, another is uncertainty. So as we're looking at these inherent risk factors, we're applying those to a particular assertion, and then we're also applying those to an account balance. You go back to that definition from the AICPA, inherent risk relates to a class of transactions, say like receivables and revenues, or an account balance, for example, cash, or a disclosure, for example, the fair value disclosure in the notes to the financials. So we pick a transaction class, such as receivables and revenues, or an account balance, such as cash, or disclosure, such as the fair value disclosure. Then we start thinking about assertions. So, you know, some of the common assertions we think about are existence, completeness, valuation, presentation, rights and obligations. So we're thinking about that laundry list of potential assertions as they relate to a class of transactions or an account balance or a disclosure. So let me use an example here. Let's suppose you're auditing a hospital, for example, and that hospital has some very large patient receivable balances or receivable balances, say from insurance companies or Medicare and Medicaid. Now, because of the volume of transactions in a hospital related to receivables and revenues, your risk is going up. The inherent risk is going up because there are tens of thousands, sometimes hundreds of thousands of transactions. There's also a risk that the hospital may not collect the amount that it has billed. And so again, the risk is going up. Now, that uncollectability issue relates to the valuation assertion. So in this example, there's a large volume of transactions. There's some subjectivity as we evaluate the value or the valuation assertion in relation to receivables. So that's how this is working. The inherent risk in this example is that the receivables are not properly valued because of the large volume of transactions and the subjectivity in computing that allowance number. Now, you've also got another inherent risk factor, and that is complexity. You've got different buckets of payments from different parties, such as private pay, such as managed care, insurance companies, such as Medicare, Medicaid. So you've got all these variations in the potential payors to the hospital. That adds complexity. So now we're looking at a minimum, subjectivity and complexity in relation to the valuation assertion. Now, another one that can come into play, and I believe does, is the potential for fraudulent presentation of that number. So if a hospital wants to look better than it really is, it could play with that allowance computation and make itself look better than it really is. So now we've got at least three inherent risk factors: complexity, subjectivity, and subjectivity, and also the threat of potential fraud or potential intentional misstatement of that valuation as it relates to the receivable account. So let's summarize here and we'll wrap up. So we go back to the words inherent risk. That's one of the factors in your overall risk material misstatement. The other is control risk. So with inherent risk, we said inherent is that which is built into an item, such as the valuation assertion. And then we said that risk is the chance that we might suffer loss. So here the risk is that there would be a misstatement. So inherent risk is the built-in risk or opportunity or probability of misstatement in relation to a number like that receivable account based on the inherent risk factors such as subjectivity and complexity. Now, one more thing I'll add here before we close. This all relates to the inherent risk without consideration of related controls. If you go back to the AICPA definition, it says before consideration of any related controls. So if there were controls in relation to that valuation assertion in that hospital, say there were, a second person and a third person reviewing the allowance computation and signing off on that to ensure that the valuation is appropriate, that would be a control. But we're looking at the inherent risk in relation to valuation in this example before we even think about whether or not there are controls. Obviously, controls would lower the risk of material misstatement, but we're talking about purely inherent risk here. Now, one more thing and we'll be done. Make sure you document your inherent risk in your audit file. So commonly in peer reviews, peer reviewer looks at the inherent risk and either it's not documented or, more commonly, every inherent risk is assessed at high because the auditor, quite frankly, doesn't know what he or she is doing. Every inherent risk is based on that account or those transaction classes or that disclosure. They're not all high at inherent risk. They're different based on the characteristics of each assertion as it relates to account balances, transaction classes, and disclosures. So you want to define and document what your inherent risks are for each account balance, for each transaction class, for your more significant disclosures. Document what the relevant assertions are for each of those accounts. And then you can perform your audit. Now, if your control risk is high, inherent risk will always equal your risk of material misstatement. So inherent risk becomes even more important if you document your control risk at high. Then inherent risk completely drives what your risk of material misstatement is. If you have a low inherent risk and control risk is high, then you have a low risk of material misstatement. Okay, so that's inherent risk. I wish you well as you document your inherent risk. Otherwise, you might have some peer review risk, and I don't want that for you. Until we meet again, take care, and bye now.